Well guys, welcome back. It's only been a minute, but let's get right into the point of this video. So I've been doing my homework recently, and I've been looking at the emerging markets. What could be the next hot thing? Now, if we caught majority of these electric vehicle stocks about a year ago or a year and a half ago, portfolios would be up thousands of percent. So what is the next hot thing? That's what we want to know. Now, the electric vehicle sector, it's hot, it's obviously delivering, and that is the future and has become the norm and will be the norm soon. But what's next? And that's what I want to go through, guys. I've picked some stocks. I want to show you them. I want to show you how I analyze them. And obviously, if you're watching this today, this week, these stocks, some of them will benefit from the new infrastructure bill that Biden wants to pass. So, with that being said, let's talk about the new sector that I want to introduce to you, or a lot of you are probably familiar with. So, let's look at this Excel sheet that I was working on. And obviously, I work on this Excel sheet just so I can find good stocks, compare them to their competitors. So here we have renewable energy, and here we have robotics. So robotics, guys, is obviously consumer robotics, which is something you're going to see more in your household. But let's look at the renewable energy sector. So we have a ticker here, Plug Power, and this is a combination of hydrogen fuel. We have solar panels and whatnot, solar energy, and we also have batteries for vehicles, for electric vehicles. But let's go through the first two here, which are two competitors, Plug and Bloom Energy. They're kind of in the same sector. So obviously, straight away, you can see one of them is already doing well on revenue growth. And that's revenue growth for 2020 based on the last year. So year after year revenue growth. Plug Power is down 140%, while Bloom Energy is up 1%. Obviously, with the revenue growth. Debt, that's how much the company has borrowed up to date. 700 million for Plug Power, it's 1 billion for Bloom Energy. However, it seems like cash flow wise, this is the money they have. Levered free cash flow, by the way, these are the figures for levered free cash flow, which means this is money after debt is paid. So this is minus 600 million for Plug Power, and this is minus 77 million, even on 1 billion debt, which is great, right? Even though it's a minus figure for cash flow, it's still great. Now, the reason why I'm looking at cash flow, because we want to know, does this company have enough money to survive for the future? Because look, we treat these as penny stocks, right? It doesn't matter if they're at $20 or so. We still treat them as penny stocks because what we want to know is, does this company have what it takes to survive? And that's what cash flow is. What is important. It's important to look at cash flow, guys. So 77 million minus 77 million is free cash flow for Bloom. So this here, it just shows even on the debt, they're being profitable while this company is still kind of emerging. So obviously, if we look at the earning per share, Plug Power is minus 365, while Bloom Energy is 57% year after year. So which one is a better option, I guess? Well, if you want to take a bigger risk, a bigger reward, you'd go for this. But if you want less risk, but obviously you still have more reward, well, you'll pick this. And I own both of these companies, matter of fact. I have shares in both of these companies. Now, the third one would be QS. QS here is minus 29% revenue growth. Debt, 62 million. Cash flow is minus 100 million. And earning per share is minus 2,000. Now, let's eliminate that stock for a minute. I do not own this stock, by the way, in my portfolio. So the next two stocks would be solar energy, SPWR, CLNE. So SPWR revenue growth is 3%, debt is 500 million. Cash flow is positive, which is very interesting. 37 million cash flow positive after all the debt obligations is paid. Earning per share, almost 2,000% increase. Wow. CLNE is the competition, minus 70% revenue growth. Their debt is 76 million, but they're still cash flow positive. Earning per share is minus 149. Now, this minus here, you don't have to worry about. Every year could be different because it could be one year they had bad sales, or they had something to fix, or they had money to spend on acquisitions or so. But what really matters to me is the cash flow. I want to know, will these companies survive long term? And that's why cash flow is important. And again, these figures come from Yahoo Finance and Wall Street Journal. Robotics. Let's look at the consumer sector, guys. I want to just go through two tickers here, because at this stage, I think you know what I'm looking at. So if you come across these in your portfolio, or just by doing simple Google search, you'll know what to look for. ABB revenue growth is minus 11%, debt 7 billion, cash flow 8 billion. That's pretty good. Now, if we look at IRBT, revenue growth is 17% year after year from 2020. And debt would be 53 million. So let's look at this one a second. So debt is 53 million, guys, and cash flow is 162 million. So again, these companies are doing well regardless. IRBT is a consumer robotics, basically, and you'll see more of them around your household. They have a product which cleans after your shit. Basically, a little Hoover that goes around the house that cleans, and you don't even have to touch it. Well, that's the company that manufactures it, IRBT, iRobots. Now, these three stocks, obviously Amazon, General Motors, and Apple, a lot of you are familiar with. So there's no reason to go through their financials, because they're cash flow positive, I'd say, except maybe General Motors. I haven't looked at the figures properly. But General Motors also has robotics, but it's robotics for the manufacturing industry. So they're in that sector as well. They have a subsidiary that focuses on that. Apple will also be getting into robotics. Amazon, we already know, is into robotics. There's nothing these guys are not into. But look, these are the next hot thing, I believe. Okay? And even if a company's already existing, well, they still benefit from the emerging market, especially if they're already involved in that market. So I think I own General Motors, I own Apple. I think next thing would be IRBT, but we'll see. But this here will benefit from a lot of the next legislations that will pass, whether it's in the US or in Europe, because what's happening now, guys, is by year 2030, the whole world wants to go green. So obviously renewable energy, hydrogen fuel, clean energy, and anything like that will benefit. And now you'll have a bubble just like we had in February with the electric vehicle sectors, which, look, if you're smart, you get in, you make your money when it hits 1,000% and you walk away, and then go in again if you wish when things get better. And then now the company that's strong will survive long term. So hopefully this quick analysis gave you something to work with. I'll see you soon. Peace and love. And just like always, don't forget that smashy smashy. Peace.